This is Jay Martin.
A project that will go from around 140 to 150,000 ounces a year to close to 300.
Yep.
We're only spending another $160 million.
This is post-expansion.
Post-expansion.
Yeah.
So we're doubling our throughput for $160 million. It's a crazy number. And the capital cost per recovered ounce is going to be one of the best on the planet.
Welcome to the Jay Martin Show. If you're a new viewer, my name is Jay. I'm an investor, probably just like you. I have 3 young kids, I run 2 small businesses. I'm just looking for the smartest home for my cash. Now today we're doing something special on the channel. We're releasing a new video every day focused on the highest quality exposure in the gold sector. My guest today is the president and CEO of Orezone Gold, a company that my newsletter subscribers know as I'm a shareholder. Today we get into the near-term growth catalyst for Orezone, why I'm so excited about this story, and frankly, why I wrote a check. As always, if you enjoy my content, check out the link beneath this video where you can subscribe to my weekly newsletter. I publish every Sunday. I love writing it, and I'd love to have you join the team. Now here is Patrick Downey. Enjoy. Patrick.
Jay, how you doing?
I'm really good. Really good.
Good to see you.
Good to see you. And I'm looking forward to this.
Yeah, so am I.
So thanks for making the time.
No, absolutely no problem.
Okay.
Pleasure.
So I want to jump into the Orezone story. My paid subscribers know I'm a shareholder. I keep them up to date on everything that I'm acquiring in the market. And I want to go deep into the story with you today. Introduce yourself to my audience, introduce the story to my audience. There's a handful of things that turned my head with Orezone. Your execution of the mine build, by the way. I mean, your relentless focus on cost. You put this thing into commercial production within 30 days of first pour and then surpassed that 30 days later. And you've got absolute tunnel vision on cost control, which I really respect in terms of you being a chaperone of my capital, right? And so we'll get into all this stuff today. How's that sound?
That's great. Yeah, absolutely. Looking forward to it.
So let's start with the gold sector, though. I want to begin here with a bit of macro, get a sense of what you're seeing and what you're seeing that you think is significant in terms of there's so many threads to pull in right now in the gold sector. And if you look at like what macro indicators are pointing to a bull market, it's almost like every single one, like chaos abounds every direction you look. So what are you paying attention to?
Yeah, I've been in the gold space now for over 40 years. And this gold sector that I'm seeing now is probably one of the best we've ever entered into for gold, in my opinion. I mean, you're seeing real fear and I would say a bit of chaos around the US dollar and where it's going and what the strength of the US dollar would be in the US economy. I think that the central bank buying has been stronger than it's ever been, and it continues to be very strong. You're seeing governments now that traditionally weren't in the gold space buying up in the central banking side of things and building up a gold bullion. And I think that a lot of that is based around they really don't know where the US dollar is going. And we think that will continue. You know, you look at the BRIC countries, you look at a lot of these countries that are more influenced by China and the East are continuing to buy. China's continuing to buy. India's continuing to buy. So there's certainly everything is pointing towards gold being strong for the very, very foreseeable future. There's also a lot of political uncertainty. I think this is, you know, I didn't grow up with the Vietnam War per se, but that was obviously a time when everybody was wondering what's happening. But look around the world right now. What is happening and where is it going? And I think that's also going to be a very, very strong vector for gold as we move forward here. So for us, we you know, I'm obviously a gold believer because it's been my living for 40 years. But as I watch it and I look at it, you know, every time I see a little bit of weakness, it comes down $30, $40. It seems to sit there, can't get pressed below that, and it takes another jump up. And if you look at gold over the past 6 months, 8 months, it just keeps taking these bounces up, and I think that's going to continue here for the very, very foreseeable future.
Well, and I like that focus on bigger picture trends because, and my audience knows this, I mean, we're value investors. We're long-term value investors. We're not traders. And so paying attention to those bigger trends is what matters. And that protects you. It protects you from the short-term volatility, which is inevitable, right?
Yes.
Especially in the commodity sector.
Yeah.
And you touched on demand. We're seeing record central bank gold buying. We saw that wrap up 2022. Q4 was 399 tons purchased. Q1 of 2023 has continued that trend. And now it's not just BRICS nations, but the number one buyer in Q1 of 2023 was Singapore, which purchased 69 tons, which just for context is a 45% increase in their gold ownership. So it's a very material shift in their gold reserves. And then you touched on uncertainty, right? Which again, it's like chaos abounds every direction you look. And if you don't know what's next, right, that's when you look to gold. Historically, it's what you hold when things transition from something to something else.
Correct. And governments are telling you that right now. When you see the likes of Singapore and whatever buying that quantum of gold in the market, it's telling you what they're thinking and what internally what they're looking at and where they're seeing the US dollar, where they're seeing their economy, where they're seeing things happening in the world. This is it's a massive vector as to what's going on everywhere around them. And that's why you're seeing that buying. And you will continue to see that buying. Because what's changed from Q4 to Q1 that's telling you shouldn't be buying gold? Nothing. It tells you should be buying gold. And so that strong demand, I think, will most definitely continue. The other thing that's happening in the market is it's taking longer to get gold projects up and running. It's harder to find those big deposits. Somebody said to me when I first started in the mining business, it's very hard to find 1 million ounces. It's still hard to find 1 million ounces. And you need bigger projects than that to make a gold mine really and truly work. And so that supply side is also becoming a bit of a squeeze from the point of view of supplying that demand. So there's lots of things are working in our favor right now.
Right. In addition to just being an undercapitalized market for the last, 10, 12 years.
Absolutely.
Right.
But I also say that to our team is really, look, we also have to focus on all of the input costs to make sure that we're a high margin, company. We're always going to make, people will still look for companies that are making money. It's not just gold, but it's also what your margins are as that gold price increases. What's my risk? What's my reward? And we all always look at that when we look at a project and how we build a project.
I want to talk about the origin story a little bit. And so if you could touch on this, the inspiration behind Orezone and what was the mission from the jump?
Well, Orezone was originally founded in the late 90s, and the guys discovered Essakane had been a very successful mine. It got a little muddied in around the middle of 2015, 2016. I stepped in. I had actually retired, but I looked at this as an opportunity to fix something and to make it a mine. Like the guys before me, they discovered the mine. I didn't discover that. It was my job to put it back on track and get it built. So there's always an evolution in mining. There's always an evolution. People who discover it, people who bring it to a certain stage, people who build it. So you look at something, and when I looked at this, I went, oh boy, there's a real opportunity here, because it was one of the biggest oxide deposits I'd ever seen. And oxide is a very, very lucrative mine if you can get the right one, because you don't have to drill and blast it, you don't have to crush it. Most of it is already ground. It's very soft ore, so you're not using a lot of energy. Generally, if the metallurgy is right, and that's one thing about Bomboré, it's got beautiful metallurgy, you can leach it really fast, so you don't have to use a lot of chemicals. And when we got our heads around that, we realized we have a winner here. Then, of course, COVID comes along. You're in the middle of your study. You've got your capital costs done, and you're going to go out for debt. Nobody wants to give you debt. It's COVID. They can't visit your project. They can't do due diligence. And there's where luck comes into play. My country manager, he said, well, I think there's a local bank here would be quite interested in funding this. And I thought, a local bank? He said, yeah, they've done one small mining project. They're interested in it. They love the fact that it's in Burkina. I said, do they know how to finance a mining project? What it works? He said, yes. So we sat down with them. They come up with the debt, very clean debt for a junior. Normally, when you've got no assets to back it against, you're normally having to put out a stream or a royalty or a gold prepay or a hedging program. None of that for us. So that gave us the foundation to build the mine. Then we put the team together. We got a great team of people, totally focused on building that mine on time and on budget. Now, we did the budget in COVID. It was about $155 million, and we built it for 148. Sorry, we did the budget pre-COVID, and we built it during COVID for 148 million, and we took no shortcuts. I can tell you that mine runs like a clock and runs highly effectively, highly efficiently, great availability of the equipment. It's really about how you view what you need to do, making sure you don't skimp on equipment, you don't buy inferior, cheaper type of parts. We laid it out so it's easy to maintain, and it's worked well. And it is you're right. It is a lot of focus to detail. Sometimes I will be accused, even by the people who work for me, to go, can you go away for a minute? You're constantly in on top of us. But I love to see how it's been done, and my money's in it. I want to say this. You say custodian of the shareholders' capital. I'm a very, very big shareholder in Orezone, and I bought it all in the market after I came on board because I believed in the project. My chairman's the same. All the people who work on it are all shareholders. So we look after it like it's our own money.
Because it is.
It is our money. And, for us, that's the win. We will win with the shareholders.
Yeah.
And that's what it is. And it's, it does take, it's a very much making sure you got the right group of people with the right outlook as well around you. Sometimes it's like growing a tree. Sometimes you got to cut a branch off, you got to prune this, you got to do this. But if you do it right, you get a hell of a strong tree at the end of it.
Yeah,
we look at it that way.
I love that, and it's the most important question that every retail investor should ask a CEO, a management team, when they're debating allocating capital. Is tell me about your skin in the game. Right. I want us to get rich together. And if I'm going to take a loss, I want you to be taking one too.
You bet. I'll just cite a little example of that for the team down on site. So we're getting about 91.5%, 92% recovery, which is better than what the test work predicted. The team came back and said, if we reduce the viscosity, which is the thickness of this slurry in the tanks, because it is oxide and it tends to be a little, sort of more syrupy, we think we can get the carbon to recirculate in the tanks quicker, and we can drop down and we can get better recovery. And they said, what do you think? Well, we've done some work. We think we can get 0.25%. And I said, what's the capital cost? So, the guy goes, well, it's really nothing. We've just got to put a small pump and a pipe in. I said, I don't care. I want you to put the capital cost, operating cost, NPV, IRR, and return on invested capital. I said, unless it's for safety or replacement capital, I need to see a return on my capital. So, and the guy was sort of, well, I said, doesn't matter what size the project is, do it that way. Then you will see what you're supposed to get, what you do get, and where you right, and are we getting something back for the money we're putting in here? Of course, it paid back in 3 months. That wasn't the point. But the point is, look at the money, look at the return, look at everything, because it's your capital.
So let's talk about your Q1 results. They just came out early May. Talk to me about your production numbers.
Well, we were very, very happy. We sort of generally predicted what we were looking at. We did 41,000 ounces. We sold 43,000. Our all-in sustaining costs were about $936 per ounce sold. That was using diesel-generated power. We were supposed to get LNG. Unfortunately, and we have a contract signed to get LNG, but unfortunately when LNG went to the moon, they basically abandoned us. So we had to pivot very quickly, find a diesel plant, put it in. We will be connected to the grid by the end of this year.
Okay.
And that will bring us back down to about 20 cents a kilowatt hour. Q1 was 63 cents a kilowatt hour. If we were connected to the grid, we would have been $800 all in sustaining costs.
Your energy cost goes down by 2/3.
$22 million of savings every year once we're on the grid.
Okay.
And you think about that as a junior, you're right out of the gate, you're mining in a African country, you're using a local contractor, brand new plant, yet we still have those results. And that's continued right in through Q2. We expect a very strong year this year, very sound margins. We expect the same next year, around about the same production, except we expect to have lesser costs all in because of the cost of power.
Yeah.
Secondly, something that people should understand is Burkina diesel costs, they don't go up and down with the Brent crude or Texas or whatever. They generally smooth the costs out. In West Africa, which is the ECOWAS, like Senegal, Cote d'Ivoire, Mali, they're about $1.30 a litre. We're $1.90 still. We expect to be $1.30 sometime later this year. If we were at $1.30, that would be another $70 an ounce off of our costs. So we're looking after all of our costs, like our reagent consumption, labor, power consumption, not cost, but consumption, are all within what that feasibility study said. That's the amount of detail we went into to ensure that we were right about this project. And we continue to see that. So we see very strong cash flows. We expect to be around $1,000 all-in sustaining or better. And we paid off $10 million of debt last quarter. We'll pay $18 million of debt this quarter. That's $28 million.
We're talking Q2 now?
Yeah.
Yeah.
That's $28 million of a $90 million debt package in 2 quarters by a junior company. Mm-hmm. And what that does for us, Jay, is we're looking at an expansion. We will have a lot of our debt paid off by the time we want to start that expansion. So then we can re-up on the debt with the same bank, hopefully.
Okay.
We're pretty confident that will happen.
Yeah.
And get going in an expansion without issuing another share in the company.
Now, what can you share with me about the expansion? This is the second stage of the Bomboré Mine.
Well, since we did our last resource, we've drilled 100,000 meters of core and RC drilling. We've made a new discovery, high-grade discovery in the project, which we think is going to be there. It's completely different part of the ore body. Very simple metallurgy. We expect to build another 4.4 million ton per annum hard rock. Again, because of the simple metallurgy of Bomboré, the oxide is 24-hour leach. The hard rock will also be 24-hour leach.
Okay,
so
just put that.
So think we just built this. We're now building a replica beside it.
Right. Now, just share the significance of that. That's a pretty expeditious timeline, 24-hour leach.
Well, what it does is it cuts down on your capital. So instead of having, originally in 2019 when we did the study with the hard rock, we didn't have enough metallurgical test work done and we had a 42-hour leach. So that would have been 6 extra tanks, 6 extra agitators, 6 extra pumps, 6 extra intertank screens, and all the power, reagents, everything that goes with it. But now with the test work, we've brought that back to 24 hours. So all of that disappears. The capital, the operating, everything comes back. And so for a project that will go from around 140 to 150,000 ounces a year to close to 300, we're only spending another $160 million.
This is post-expansion?
Post-expansion.
Yeah.
So we're doubling our throughput for $160 million. It's a crazy number. And the capital cost per recovered ounce is going to be one of the best on the planet.
Okay.
And we don't have to put any extra tailings in. We're not putting any extra reagents, all the same reagents, water supply systems, all the roads, camp, everything is already in. All that capital is sunk and spent on the oxide.
Yeah.
The power line that's going in for the oxide serves the hard rock.
Okay.
No extra cost there. So it's a very, very simple, capital effective expansion. We're very excited about it. It'll put us into the realms of one of the best producers in West Africa for the intermediates. To be in that 300,000 ounce a year at between 800 to 900 all-in sustaining cost.
Okay. Now, what's the timeline of this expansion?
Finishing the study right now. All the met work's done. The resources will be all updated this week. We've started the mine planning already. We expect to have the study out in Q3. So that'll be and we expect, hopefully, to announce our debt package at the same time, which would be a very positive.
Okay.
And if that happens and we continue to have the strong cash flows that we're having this year, right now our timeline is to really start construction at the beginning of Q3 2024. But if things continue the way they are, we see ourselves pulling that back by 4 to 6 months. So we could, instead of starting production of the hard rock in Q3 of 2025, we'd be early in 2025. So
Okay,
we'd almost
got
have a full year of that sort of 300,000. So we'd be going from 2023 at 140 to 150 to 2025 to 300 sort of range.
Okay.
And simple open pits, still wide open, Jay. I mean, we're only down on average 200 meters into these pits. Most pits go down 300-400 meters. So think about that. We think we'll be coming out somewhere in the 6 million ounce sort of resource range, maybe closer to 7 to 200 average depth.
Okay.
Most pits are down to 400. You can do the math.
Yeah.
That's a big mine, and it's a long life mine. Why are we building? People say, well, why won't you build it bigger? Well, because we're not going to blow up the company structure with a big debt package that our bank would have trouble helping us with. We're designing the plant so that we can add a ball mill and tanks at the end of it. We can go to 8 million tons per annum very easily in 2 to 3 years' time.
Okay.
So we're designing this with a lot of flexibility in the project.
So right now you're looking at about around 140, 150,000 ounces per year. You're aggressively paying down your existing debt facility so that you've got ideally the option to go back to that trough to finance the expansion. The logic's there. If they liked you before production, they're going to like you more afterwards, right?
Absolutely.
You got cash flow now. Why? And you've proven the model works, right? You did everything you said you were going to do, which is rare in the junior mining business for a CEO, as I'm sure you know.
Well, it's about having the right guys around you. I mean, a lot of the people that have worked with me have been there before with us. So
well, you've got a rich history in Africa in general.
Yeah, and we also have a group of people down there that are second to none. I mean, I could put them anywhere on any mine, and they could do a top-notch job. People don't understand. Burkina, for all people would say about it, there's 16 mines being built in an area the size of Colorado. 16 mines. You think of the skill sets that are there in the construction,
right,
in the operations, in the administration. It's all there. We're running a 5.7 million ton per annum open pit operation with a local contractor with 3 expats.
Right.
3.
Yeah.
Not 40. And it's running like clockwork.
Now, what can you share with me about the life of mine post this expansion?
Post-expansion, it will still be in the sort of 14-year range.
Okay.
We're still drilling, and we will hopefully drill later this year. I would say if I'm a betting person, Bomboré is a sort of a 25 to 30-year life of mine.
All right.
That's what I would see. We're opening up new areas. We're still shallow in the system. These orogenic deposits go forever. We see the main deposit is a large shear. We're now seeing these folded granite diorites that are appearing throughout the project. We're getting a better understanding of that. We will come out with a 3D model that will be done, probably by June, July. We'll be able to show the world what we're seeing here. For the first time ever, we're bringing a structural geologist, PhD, onto the property to start pulling it apart because we see so much happening there. So you've got this shear that's dipping this way. You've got this later event that's coming in that's juicing up the mineralization that we only found in 2016.
Okay.
And we didn't find it, by the way. The artisanals found it for us. And now we're seeing it appearing throughout the system. We think this is going to open up a big exploration platform for us in the future.
That's the future optionality that you're most excited about.
Yeah.
Right.
And we hope to drill a couple of deep holes this year.
Okay.
Got a few targets that we're looking at. Yeah. So hopefully we'll surprise the market with a few.
Because I'm always interested in the bigger picture. I mean, and by the way, the expansion plan, I mean, that's really near term, right? Yeah. We're looking at 24, 25. That's not that far away.
No.
At all. You were brought on, as you said, to get this thing, to fix this thing and get it up and running. Mm-hmm. Would you look at expansion through acquisition? Is this at all interesting to you?
Yeah, I think of all the places I've worked, West Africa is absolutely ripe for consolidation, but really good consolidation. If you look at the companies, successful companies that have been built out of that in the very near past, like Perseus, Endeavour, you look at some of the bigger companies like Randgold. Really, what is Barrick? It was Randgold's big assets in West Africa, which are still B2, best asset it's got.
Yeah.
Mali.
Yeah.
And it's still wide open for exploration. You look at Endeavour in the Greenstone Belt in Côte d'Ivoire have made 2 world-class discoveries in the past 3 years. So is there opportunity there? Absolutely, there's opportunity there. And opportunity for really tier 1 type of assets. It's still underexplored. You know, there's not a lot of, it's the biggest exploration, you know, dollars in right now is going into West Africa. It's the biggest producer in the world, West Africa. And people don't really know about it. And if you look at, you know, where some of the classic deposits are coming from, it's from there. And those greenstone belts, those orogenic deposits, they will go on forever. So yes, we see a lot of opportunity there. The fact that we've got a local bank behind it that is in every one of those countries and knows intimately those countries helps us.
Okay.
The fact that we're a producer that's got cash flow, that you know, access to capital. There's other juniors out there that have got some really good projects, but for them to finance and grow them is extremely difficult right now.
Yeah.
And any sort of thing we look at, we want to make sure that those people did well out of it. Any M&A that I have done, Jay, it's always been, I think, I look back at my M&A career, everybody's done a deal with me has done well,
Okay.
including me. But those companies have gone on, and those projects have gone on to be really critical to their growth.
Yeah.
So I'd look at it the same way if I was grabbing somebody's baby and raising it, you know, making sure that we do it right.
Yeah.
And those opportunities definitely exist.
I have to ask, what do you think inspired this bank to take this gamble at the time? I mean, you were a high risk
Big
bet.
gamble, yes. You know what? When I met with them, great story, great question. When I met with them, my country manager introduced me, and actually, I'm a pretty straightforward guy. I didn't think they had 90 to 100 million to lend to a mine, high risk, junior. I said, look, I mean, I'm looking for $100 million. I mean, you've got a lot of people here. We could be wasting an hour of our lives, me talking about building a mine. Do you think you've got 90 to 100 million dollars? And he looked at me and said, well, why don't you tell your story and we'll figure that out. Okay. We went through it. He said, okay, we like this. We know a bit about it, but here's the thing. We want to go visit the project without you there, without him there, which is my country manager. We want to talk to the local leaders. We want to talk to the local ladies groups. We want to talk to the villagers, etc. We want to talk to the artisanal miners in the area. I said, yeah, sure. I said, why that first? He said, well, we're a local bank. We can't be embarrassed. We've got assets all over this country. If we're going to do business with you, we've got to make sure that it's going to be good business, that it doesn't cause us any embarrassment in this country. He said, we live here, you don't.
Sure.
I said, yeah, absolutely. So they went, visited. I knew we had great community relations. We worked very hard at it. They came back and said, yep, we can come up with 90 to 100 million. And they did, under very, very commercial friendly terms. And here's how good they were. We discovered this deposit. We knew it was getting bigger, but we were stuck. We're building a mine. How do we figure out where the expansion? Most people can't look at expansion until you've got the mine built. Yeah. We went to them, we showed them what we're drilling. We said, if we had $10 million, we think we could get enough M&I for a mine that would be this size. I said, okay, put a proposal in.
Yeah.
A week later, we got the 10 million.
Okay.
Then when the lights went out on the power in September, when our power provider abandoned us, we had no power. Now you got 90 million of debt.
Yeah.
No cash flow.
Right.
1,000 people on your project.
Yeah.
Your board's panicking. We went to them and said, look, we think we can get this power plant in. We think it'll work. and we can get it done in a month and whatever, but we can't pay back any of the debt.
Yeah.
They come back and said, okay, we'll give you this month's, time to get back on your feet, which was 3 months. Don't pay us any money. They didn't charge us an extra fee. Can you if you were dealing with a European bank or a South African bank or a New York bank, you would have been screwed. These guys just basically stepped aside, let us fix it, got back on our feet, all good. That's the relationship we have with that bank.
Okay. I find myself wondering if you only having 3 expats on site has any relationship with them appreciating your operation.
Yes, very much so.
Okay.
Very much so. It was us taking a leap of faith with a local contractor who'd never done mining before. He'd done ore haulage, but never done mining.
Okay.
We told him we would work with him. Now, we had to mine a pit out, Jay, that was going to become a water reservoir. So we were able to spend that year with him, making sure he understood our systems, grade control, where everything went. We simplified it with him and worked with him. Maintenance of equipment, make sure you got availability of equipment, all of that.
Yeah.
The banks love that. Our general manager is a Burkinabe. He's actually a schoolmate of the chairman of the bank. And so they know each other. But we give him the opportunity. This guy, he's a geologist, he's come through the ranks, but he knows how to run a mine, and he knows all of the politics of heads of department and different, how it all makes sure that it runs effectively. Our finance manager is Burkinabe. Our head of technical services is Burkinabe. They love that fact that we give people opportunity, but we support them. They know, we look at things in a lot of detail. We look at short-term mine planning, long-term mine planning. Like our process superintendent our manager, intimately involved with our expansion. Went and visited the test work and watched what was going on in the test work. So we bring them into the fold at a sort of a corporate higher level.
Yeah.
So we're not just saying, you're down there, run it and make money for us. No, you're part of the growth, part of the company, where the company wants to go. And that has really, resonated strongly throughout the operation and with the banks.
Okay.
They love the fact that we're giving people opportunity.
Of course they do. Makes all the sense in the world. Okay, so cash position right now is around 42 million, if I've got that correct.
It's stronger now. We're still
now.
We're still producing. It's all good.
Yes, of course you are. That was as of Q1 results, right? Beginning of May. We touched on your debt repayments,
yes,
right? And creating that optionality to borrow more should you need to.
Yeah.
This reduces your necessity to go back to the market to raise capital. Correct. And dilute existing shareholders, myself included, much appreciated. I want you to touch on company valuation and specifically in relation to your peers.
Right. Great question, Jay. I mean, this is the one area, like last year, as you know, my focus was get it built, make it run properly, make sure everybody understands that. I look around at our peers, and some of them are in Mexico, single asset companies. That's what we're looking at. Same sort of production profile, 100 to 150 type of.
Great.
We look at their costs. We think we're right there, as good, if not better than most of them. We're in jurisdictions. The funny thing is, from an investment point of view and getting your capital and return on invested capital, the Fraser Institute has Burkina at 31, Mexico at 45.
Okay.
And Papua New Guinea at 57.
Okay.
So we're ahead of all of them in that.
This is Fraser Institute rating the confidence and return on capital.
And political risk and all that good stuff.
Okay.
And I look at our peers who are there, and they're at a minimum 3 times our valuation.
Mm-hmm.
I look at our growth. They've got growth. I look at our growth. It's open pit. We're already mining. We're just going to be mining a little deeper in the pit. We're not having to pre-strip. The pre-strip is what we're doing right now, the stuff we're processing. I look at the capital it's costing per produced ounce. We're better than any of them. So I think once we get that message out, there's a huge valuation gap for us. I mean, there obviously will be, and always is, a West African discount. It seems to be around 0.8, but it's not 3 to 1.
Sure.
And we're going to close that gap. And people are going to get confidence, A, we know what we're doing, B, we're producing at great cost. C, we've got an expansion that's not going to blow the treasury up.
Yeah.
Better than most of them. And we've got a platform to run right into it. And we've got a bank that's backing us. So I hope, I mean, maybe there's a management discount. I don't know. There could be. But I hope that we see that gap closing and closing fast. Because there's no reason why we should be sitting at a third the valuation of somebody, say, in Papua New Guinea or parts of Mexico or wherever at this point in time.
Do you think it's just a consequence of having just put out Q1? I mean, relatively new, right?
Yes, correct. It is.
On the production front.
It is.
Okay,
It
get
is.
a couple quarters under your belt.
I think we get those quarters under our belt. We
Yeah.
get that study out. We get the announcement on the bank debt.
Yeah.
And we get going early on that expansion. There has to be an absolute, close of that 3-to-1 gap.
Yeah.
So there's if you look at it even as a 2-to-1, there's a freebie of a 2-to-1 here just on what we're doing today. So that's why, I still remain a strong buyer of the stock. When it hits that $1.25, I'm in.
Yeah.
And, we see a huge, and we know our own project. We know the risks and reward, but we look how well it runs. I mean, we're running at 10 to 13% above nameplate. We're running at 1 to 2% better than recovery. Our open pits, our contractors pushing 50,000 tons a day when need be, and when we're stripping. We normally mine early in the dry season, so we've got enough space within the pit to catch any water and stuff, so we can smoothly run during the rainy season. And we've done that. This is our third rainy season now.
Yeah.
So we look at the risks of us and how well we do grade control and how well we do reconciling our ore body to what it is. To be frank, this ore body is always delivered. I mean, when you go from inferred to measured to indicated to proven to probable to grade, the tons go up and the grade goes up. The more drilling you do, the better this ore body looks. It's great.
That's great.
So
Okay.
I think that the risk for us is minimal. We've got 10 to 13 years of oxides and 10 to 14 years of hard rock here ahead of us. Plus, we're still wide open.
All right, Patrick, I want to wrap it there, and I want to thank you for coming and chatting with me today.
No, thank you. A pleasure. Always. I should have come earlier, but building a mine, sometimes you got to build a mine. Really looking forward to Q2 and the future of Orezone.
This is Jay Martin.